Now, with Warren Buffett preparing to step away as CEO, Berkshire Hathaway isn't just facing a leadership transition, it's facing the loss of its most recognizable voice. And that raises a quieter, more uncomfortable question. What happens to a company built on long-term trust when the person who earned that trust is no longer the one speaking? To understand why this matters, you have to look beyond financial statements and focus on a role Buffett played that rarely appears on balance sheets. Buffett was never just an investor. Publicly, Warren Buffett is known for disciplined investing and patient decision-making. But inside Berkshire Hathaway, his influence extended far beyond capital allocation. He became the interpreter of the company. Berkshire is not simple. It is a collection of dozens of businesses across unrelated industries: insurance, energy, railroads, food, manufacturing, retail, and consumer brands. For many companies, that level of complexity creates confusion. For Buffett, it became a narrative. Year after year, he explained how the pieces fit together, not through jargon, not through marketing language, but through calm, deliberate communication. Letters written in plain language, interviews that avoided exaggeration, answers that acknowledged uncertainty instead of hiding it. That communication style didn't just inform investors, it shaped how people felt about the company. And feelings in business are more powerful than numbers. The annual meeting that became something more. Most shareholder meetings are procedural, required, forgettable. Berkshire Hathaway's annual meeting became the opposite. Every year, tens of thousands of people traveled to Omaha. Not just institutional investors, but families, students, entrepreneurs, and longtime shareholders. Many weren't there to trade stock or ask technical questions. They were there to listen. The meeting evolved into a place where financial education, curiosity, and community overlapped. People lined up for hours, not because they expected dramatic announcements, but because they trusted the person speaking on stage. And then there was something else, something no one expected from a multinational conglomerate. Shopping, the bazaar that shouldn't have worked, but did. Inside the annual meeting venue, Berkshire created what became known as the Berkshire Bazaar of Bargains. It wasn't flashy, it wasn't aggressive, it didn't feel like marketing. Instead, it felt oddly personal. Products from across Berkshire's portfolio were displayed in one place: candies, clothing, toys, household items, food products. Not because they needed exposure, but because they represented the businesses behind the numbers. By 2025, the bazaar reportedly filled tens of thousands of square feet and featured tens of thousands of items. But the scale wasn't the point. The point was familiarity. People didn't walk through the bazaar as customers. They walked through it as participants in a shared story, one where the company they owned a piece of also produced things they could touch, eat, wear, or give as gifts. And quietly, Warren Buffett became part of that experience. When the CEO becomes a symbol. Buffett didn't promote himself, he didn't brand himself, yet over time, his image appeared on products, signs, and displays, not as an advertisement, but as a presence. Photos of him smiling next to mascots or novelty items became expected, normal, comforting. This mattered because it humanized a company that, on paper, was anything but human. Instead of being a distant conglomerate, Berkshire felt approachable. Instead of being abstract, it felt grounded. And nowhere did this become more visible than in one unexpected category: the plush toy that explained everything. Squishmallows are soft, rounded plush toys that became popular across age groups. On the surface, they have nothing to do with investing or corporate governance. Yet through a series of acquisitions, the company behind them became part of Berkshire's wider ecosystem. When plush toys depicting Buffett and his longtime partner appeared at the annual meeting, the reaction was immediate. They sold out, not because of scarcity alone, but because they represented something deeper. They were symbols of trust, continuity, and shared history, wrapped in something lighthearted and accessible. Some later appeared in online resale listings at much higher prices, according to publicly available information. But the real value wasn't monetary, it was emotional. Why this was never an accident. Buffett has often spoken about buying businesses whose products he genuinely likes and understands. That philosophy extended beyond spreadsheets. One of the earliest examples was See's Candies, acquired in the early 1970s. It wasn't a revolutionary company. It didn't scale aggressively. It simply had loyal customers. Over decades, it became a case study in how brand trust compounds quietly. At Berkshire events, See's Candies wasn't presented as a profit center. It was presented as a shared tradition. And traditions create attachment. Familiar brands, familiar faces. See's Candies wasn't an exception, it was a template. Buffett repeatedly showed preference for companies whose products were already part of everyday life. Things people didn't need to be convinced to use. Things they already trusted. That same pattern appeared again years later with Berkshire's involvement in Heinz. When Berkshire partnered to acquire Heinz, the logic wasn't built on trends or novelty. It was built on recognition. Heinz was already in kitchens, already associated with consistency, already part of routine. And that's where something subtle happened. Promotional materials and novelty items connected familiar products with familiar leadership. Not endorsements, not campaigns, just quiet associations. Images that suggested continuity rather than change. For the public, this created a mental shortcut. If Buffett is involved, this company is meant to last. The absence of hype was the message. One of the most overlooked aspects of Buffett's influence is what he didn't do. He didn't overpromise. He didn't chase attention. He didn't speak in extremes. In an environment where corporate messaging often feels inflated, Buffett's restraint stood out. He openly acknowledged mistakes. He publicly discussed disappointment when investments didn't work out as expected. That transparency wasn't weakness. It was credibility. Over time, people didn't just listen to what he said. They trusted what he didn't say. And trust, once earned, extends beyond the individual. Or at least, that's the theory. When leadership is also education. For many shareholders, the annual meeting wasn't about returns. It was about learning. Buffett and his longtime partner Charlie Munger spent hours answering questions. Some were technical, others were philosophical. Many had nothing to do with immediate profits. They talked about patience, incentives, human behavior, mistakes. That turned the meeting into something closer to a classroom than a boardroom. People didn't leave with tips. They left with frameworks. And those frameworks shaped how an entire generation thought about business and investing. Why personality matters more than it seems. Large corporations often insist they are bigger than any one person. Structurally, that's true. But culturally, personalities matter. Buffett's presence created a sense of coherence across dozens of unrelated businesses. He was the connecting thread, the reason people saw Berkshire as a single entity rather than a loose collection of assets. Without that thread, perception changes. Not overnight, not dramatically, but gradually. The transition Berkshire was built for. To be clear, Berkshire Hathaway was designed to survive leadership changes. Its decentralized structure allows individual businesses to operate independently. Capital allocation follows defined principles. Success doesn't rely on constant executive intervention. From an operational standpoint, the company is prepared. What's less certain is how the public experience shifts. The letters may become more formal. The meetings may become more structured. The tone may become quieter. None of that is inherently negative, but it is different. The difference between stability and inspiration. Stability keeps companies alive. Inspiration keeps people engaged. Buffett provided both. He reassured investors during uncertainty, but he also gave them something to look forward to. A letter, a meeting, a perspective. Without that presence, Berkshire doesn't lose its fundamentals. It loses a layer of connection, and connection is what turns shareholders into long-term believers. The question that comes next. So the question isn't whether Berkshire Hathaway will continue to function. It will. The question is whether the company's identity, as something understandable, relatable, and quietly trusted, remains as strong without the person who shaped it. Because once the storyteller steps away, the story doesn't end. It just has to be told differently. What remains when the voice is gone? When Warren Buffett steps away from the CEO role, the immediate mechanics of Berkshire Hathaway remain unchanged. The subsidiaries continue operating. The cash flows continue moving. The balance sheet remains one of the strongest in the corporate world, but something less measurable begins to fade. For decades, Buffett served as a filter between the company and the outside world. He contextualized results, he slowed reactions, he reframed short-term noise into long-term perspective. That function doesn't disappear, but it becomes distributed. And distributed voices rarely sound the same. The quiet power of consistency. Buffett's real advantage wasn't charisma, it was consistency. He said similar things year after year, not because nothing changed, but because principles don't need reinvention. That repetition created familiarity. Familiarity created comfort. Investors didn't just know what Berkshire owned, they knew how Berkshire thought. That alignment is harder to maintain without a central narrator. Why the annual meeting will feel different. The Berkshire Hathaway annual meeting will continue. Questions will still be asked. Financials will still be discussed. But the tone shifts. Less storytelling, more structure, more formality. That may appeal to institutions, it may feel less engaging to individuals. And while institutions hold capital, individuals carry narrative. Legacy as a business asset. Very few CEOs turn themselves into a long-term asset for the company. Buffett did, not intentionally, but inevitably. His credibility reduced friction. His reputation lowered skepticism. His presence attracted attention without demanding it. These effects don't vanish instantly, they taper. And how Berkshire manages that taper matters. The next generation's challenge. Future leadership doesn't need to imitate Buffett. In fact, trying to would likely fail. The challenge is different. Maintaining clarity without personality, trust without familiarity, and patience without a visible example. That's harder than managing cash. The unspoken risk, no one models. Markets model risk. Analysts model scenarios. Companies model downturns. But few models account for the loss of narrative authority. When people don't know how to interpret events, they react faster, and often incorrectly. Buffett slowed interpretation. Without him, Berkshire relies more heavily on systems and less on explanation. That's efficient. But efficiency isn't always reassuring. Why this matters beyond Berkshire. This transition isn't just about one company. It's about what happens when long-term leadership exits an environment built on short-term attention. Buffett proved that explanation can outperform excitement. That restraint can outperform noise. Whether that approach survives beyond him is the real test. A company designed to endure, a story designed to evolve. Berkshire Hathaway was built to last for decades. Its story, however, is entering a new phase. Not louder, not weaker, just different. And how that difference is perceived will shape the next generation of shareholders. Outro: Understanding over shock. Warren Buffett didn't create trust through spectacle. He earned it through repetition, honesty, and patience. As he steps away, Berkshire Hathaway keeps its structure, its discipline, and its capital. What it gradually loses is a single, familiar voice, explaining why any of it matters. The next chapter won't be defined by headlines or dramatic changes. It will be defined by whether understanding survives without the person who taught it. In the next video, we'll explore how Berkshire's leadership system is designed to function after Buffett, and whether a company can remain deeply trusted without a public storyteller guiding the narrative.